Dear students, from today onwards, we are starting the revision for advanced accounting. So from today, we have almost 50 days for Jan 26 exams. If you're writing exams in May or September, also you can use these videos for your revision. So first, നമ്മൾ ആ chapter പഠിച്ചിട്ടുണ്ടാവണം, then only this will be useful. Okay. We are starting with buyback. But why we are starting with buyback? You all know. If you take consecutively last 10 attempts, all the 10 attempts we have question from buyback in advanced accounting, which means it is very, very, very important. And less investment is required. So buyback of equity shares. A small chapter, and this chapter covers meaning of buyback, conditions for buyback, what are the sources for buyback, and very important from the exam point of view, computation of maximum number of shares to be bought back and accounting entries. ഇത്രയും areas ഉണ്ട്. So we'll quickly get into meaning of buyback. What is the meaning of buyback? Buying back on equity shares from open market. You are buying back on equity shares from open market. For what? Why you are buying back on equity shares from open market? For increasing what? Promoters shareholding. For increasing promoters shareholding. Why we are doing this? For increasing promoters shareholding. So buying back on equity shares from the open market for increasing promoters shareholding. So we are trying to cut off this outside shareholders. Company is buying the equity shares to concentrate control into the hands of promoters. Promoters in the shareholding increase cheyanana. Okay. Now, what are the conditions for buyback? So, you know which section is dealing with buyback of equity shares? Section 68 of Companies Act. As per section 68 of Companies Act, if there is buyback, what are the conditions for buyback? This can be a 4 marks or 5 marks question. So what are the conditions for buyback? It should be authorized by. For what are the conditions for buyback? So first one is what? So what are the conditions for buyback? First one, quickly, authorized by articles of association. So exam you should write it as articles of association. Don't write short form. Articles of association. If the percentage of buyback is less than 10%, then if the percentage of buyback is less than 10%, you need board resolution. Board resolution is required. Or else special resolution in general meeting. You need to pass special resolution in general meeting. Okay. Now, so check your articles of association. Then you pass board resolution or special resolution as required. Then declaration of solvency has to be filed with. Declaration of solvency has to be filed with ROC. Declaration of solvency has to be filed with ROC. And once the declaration of solvency also filed, and what is the time limit? Buyback of equity shares should be completed within 12 months or 1 year from the date of passing resolution. From this date of passing resolution, buyback should be completed within 12 months. And only what? Fully paid up shares. Only fully paid up shares can be bought back. Only fully paid up shares can be bought back. And you know what? After buyback, the shares bought back should be cancelled within 7 days. Shares bought back should be cancelled within 7 days. Perfect. And only fully paid up shares can be bought back, which means if there are partly paid up shares, if I get a question on partly paid up shares, then what I'll do in exam, I need to do buyback, but the shares are partly paid up. Then what should I do? Institute will be tricking you by giving partly paid shares. Then you should pass the journal entry for final call. Make the shares fully paid up and then do buyback. So what is the entry for final call? Final call journal entry is share final call account debit to. So share final call account debit. Share final call account debit to equity share capital. So this buyback concept is there only for equity shares. So share final call to equity share capital and bank account debit to share final call. Bank account debit to share final call. These are the two entries. So first you make the shares fully paid up and then do buyback. Okay. Now, what are the sources for buyback? What are the funds you can take for buyback? Sources for buyback. Buyback, you have two sources. One is internal source. What do you mean by internal source? On profits. You can use on profits. On profits means you can take funds out of securities premium. You can take fund out of securities premium, then free reserves. Securities premium and free reserves, general reserve, P&L you can use for buyback. Now, if you're using internal sources, then you should create CRR, capital redemption reserve. Then you should create capital redemption reserve. Capital redemption reserve to be created is equal to face value of shares bought back out of reserves. Face value of shares bought back out of reserves. You should create CRR. So we'll discuss about why should the company create CRR. Let's discuss about it. But before that, there are two sources for buyback. One is internal source and the other one is external source. Internal source, external source. What is the only external source which you can use for buyback? Can you raise loan to buy back equity shares? No. The only one external source is proceeds out of fresh issue. Proceeds out of fresh issue of shares or debentures. Only shares. That can be preference shares or equity shares. So here CRR is not required. Proceeds out of fresh issue of shares. Here CRR is not required. CRR is not required. So CRR to be created is equal to face value of shares bought back minus face value of shares issued for buyback. You take what is the face value of shares bought back. Deduct face value of shares issued for buyback. Because if face value of shares are issued, external sources raised, then CRR is not required. CRR is not required. So face value of shares bought back minus face value of shares issued for buyback is the amount of CRR to be created. Okay. We are revising. I hope you have studied this chapter before. So we are quickly brushing up the points. Okay. Now, the very important, or this time in this September 25 exam, we got a question on maximum number of shares that can be bought back as an MCQ. Case scenario, maximum number of shares that can be bought back. So it is very common to get a question on maximum number of shares that can be bought back. Guys, it is very, very easy. So maximum number of shares that can be bought back is least of the three test conditions. The results you are going to get in three test conditions. Take the least one. So what are the three test conditions? First one is share outstanding test. What is shares outstanding test? Take total number of equity shares. Take total number of equity shares outstanding. As on the date of resolution, what is the total number of equity shares outstanding into 25%. Okay. Now, second one is resource test. Resource test. As per this test, how much resources you can use for buyback? There is a capping or there is a limitation for the resources which you can use for buyback. ഇത്ര amount use ചെയ്യാൻ പാടുള്ളൂ എന്നുണ്ട്. So ആ ഫണ്ട് വെച്ച് എത്ര shares buyback ചെയ്യാം. So what is the resource test? Resource test is we are applying a formula 25% of 25% of paid up share capital plus securities premium plus general reserve plus P&L. Take the total of these four items divided by buyback price. So you take the total of this four, which gives you, you take the total of this four items, that is the fund you can use. So take the total of this four items into 25% is the fund you can use, divided by buyback price gives you maximum number of shares that can be bought back. Okay. And the last one is debt equity ratio test. Debt equity ratio test. And what is the rule? After buyback, debt equity ratio should be, after buyback debt equity ratio should be 2:1. So the point is, at the time of buyback, you know what happens? Equity comes down. At the time of buyback, what happens? Equity comes down. Equity comes down. So maybe your debt equity ratio is in a favorable position. Favorable ആയിട്ട് നിൽക്കുകയാണ് before buyback. But after buyback, equity comes down drastically. So it can, for example, if your debt equity ratio is in correct position, 2:1 ratio, your debt is 200 and your equity is 100. And at the time of buyback, what happens? This equity comes down. So maybe after buyback, your equity becomes 70. Then this is risky or unfavorable from the investor's point of view. So what is the point? Ensure after buyback, your debt equity ratio is 2:1. So what are the calculations required? We are going for the easy calculation. What are the calculations required? First, compute total debt. So when you compute total debt, you can take long-term borrowings plus short-term borrowings, if any. Long-term borrowings plus short-term borrowings. If they have given current liabilities, then I cannot take. Current liabilities can be other current liabilities. It can be trade payables. So, bank overdraft, short-term loan on the tannal, I can take the total of long-term plus short-term. Take the total debt. Then to find total debt. Then determine minimum equity or required equity. What is the minimum equity? How much is the minimum equity required or required equity? Is this step 1 divided by 2 is the minimum equity required. Yes or no? If total debt is 1000, then minimum equity is 500. Then only it becomes 2:1 ratio. Yes. Then compute present equity. What are the items I can take for the computation of present equity? Paid up share capital plus securities premium plus general reserve plus P&L. Take the total of present equity. Other reserves are all not considered. CRR should not be considered. Take present equity. Only these 4 items will form part of this present equity. And then dilution possible. Dilution possible is step 3 minus step 2, present minus minimum equity, and number of shares that can be bought back under this test is step 4, dilution possible divided by buyback price plus transfer to CRR. See, this dilution possible, this much funds you can reduce, but that fund is a total of, using that fund, dilution possible, if dilution possible is 200, the 200 is inclusive of buyback price and transfer to reserve. Together you can reduce only 200. Here what I understand is, നമുക്ക് 200 കുറയാൻ പാടുള്ളൂ എന്ന് പറഞ്ഞാൽ share capital will reduce with face value. Premium on buyback, sorry, 200 only can reduce means share capital കുറയാം. എത്ര കുറയും? Number of shares bought back into 10 face values, assuming 10 as the face value. Then reserves and surplus, free reserves and securities premium will reduce by premium on buyback. So this face value plus premium on buyback together forms buyback price. Again your reserves and surplus will reduce with transfer to CRR. So what you should so how many shares you can buy back is dilution possible divided by buyback price plus transfer to CRR. So accordingly we can find out what is the number of shares you can bought back. That we'll try an example and find out. Okay. Now journal entries for buyback. So the first entry for buyback is equity shares bought back to bank. So number of shares into buyback price. This is what from the asset side cash will reduce to that extent. You bought equity shares. Now the shares bought back should be cancelled within 7 days. What is the cancellation entry? Equity share capital debit, number of shares into face value. Premium on buyback, number of shares into, what is the excess amount you paid? Premium to equity shares bought back. Now, this premium on buyback, you can finance first out of securities premium. Then if there is no fund in securities premium, you can take out of free reserves. securities premium or general reserve or P&L to premium on buyback is fine. And if there is no fresh issue, if there is no fresh issue, or there is fresh issue but you have also taken fund out of on profits, then create CRR, free reserves to CRR, preferably revenue reserve to CRR, general reserve to CRR, or P&L to CRR. That is based on and the amount to be created is equal to face value of shares bought back out of free reserves. Okay. Now, generally, these adjustments can also be there. Okay. Then in addition to this, there are few adjustments which usually come with, there are some adjustments which usually come with buyback. One is bonus issue. So what are the journal entries for bonus issue? First, you use fund out of CRR first because CRR is having only one function, issue of fully paid bonus shares. So first you take fund out of CRR, then you take out of, if there is fund, you can take out of securities premium or general reserve, P&L. 2, bonus to shareholders, then bonus to shareholders to equity share capital. So this normally comes with this buyback question journal entries. So be clear with the bonus issue entry. Bonus issue is nothing but capitalization of reserves. Okay. Then generally redemption of preference shares. I hope that is clear, but still, what is redemption journal entry? Preference share capital debit. Preference share capital debit with face value of preference shares. If premium on redemption there, premium on redemption to preference shareholders account. Preference shareholders account. Okay, that is my first entry. Then preference shareholders account debtor to bank. So this is the due entry when redemption is due to preference shareholders. When you make the payment, preference shareholders account debtor to bank, then create CRR. If free reserves are used. Free reserves to CRR. Create CRR. How much amount is to be created as CRR? Face value of preference shares redeemed. Or whenever there is buyback of equity shares or redemption of preference shares out of own profits, you need to create CRR. The concept is nothing but when preference share capital is reduced or equity share capital is reduced, the share capital should come back to its original state. If equity share capital was 500 equity shares, equity share capital is 500 equity shares of rupees 10 each, of which 50 shares we bought back. So now my share capital becomes 450 into 10. What my Companies Act is saying, bring it back to 500. Either you go for fresh issue. If fresh issue, it's fine. You have already brought in share capital. If there is no fresh issue, bring in additional shares by creating CRR, bonus shares. Issue bonus shares and somehow bring the share capital back to its original number, original state. That is the concept of creating CRR. So fresh issue is there means no need to do no need to create CRR and issue bonus shares. But if fresh issue is not there, then we create CRR, and from CRR, the only function of CRR is to create The only function of CRR is to issue bonus shares. So again, it will come back to its original state, original number, original capital. Okay. Now, so create CRR. Now, ESOP. Next adjustment which can come as ESOP. So ESOP. What is this ESOP? If shares are offered to employees. The shares are offered to employees at concessional price. Shares are offered to employees at concessional price. So 50 rupees shares are offered to employees at 15 rupees. Then company's expense is 35 rupees. 50 rupees is the market price, but we offered to employee at what price? We offered to employee at what price? 15 rupees. But why concessional price to employees? Because to retain them. To retain them, say there will be a condition, you continue for 3 years, or you continue for 5 years, or you continue for 2 years. 2 വർഷം continue ചെയ്യണം, 3 years continue ചെയ്യണം, 5 years continue ചെയ്യണം. There will be some condition. So based on that condition, we are giving for that. If you satisfy the condition, you can get 50 rupees shares at rupees 15. So what is the accounting treatment? So during vesting period, what do you mean by vesting period? During vesting period means nothing but condition period. During this condition period, what is the entry the company should be passing? Employee benefit expense or employee compensation expense. Employee expense, because company is suffering this 35 rupees. Yes or no? 35 rupees during the vesting period. If 5 years vesting period, 35 divided by 5 only will be recognized. Matching concept. We'll be recognizing 7,777 over 5 years. 2. ESOP outstanding account. And when the employee take the shares, what is the entry? Bank account debit. Employee will pay you 15. ESOP outstanding account debit. Company will reverse ESOP outstanding account with a balance of 35. To share capital, face value, and excess will be reversed to securities premium. This excess amount will be transferred to securities premium. Are you clear? The excess amount will be transferred to securities premium. Now, this is an option. What if employees come and say, we don't want your shares. Employees are not paying this 15. Then balance in ESOP outstanding account will be reversed to general reserve. If nobody is exercising, nobody want the shares, the amount in ESOP outstanding account will be reversed to general reserve. Okay. So these are the adjustments that normally comes for exam. So what I'm going to do is I'll take the September 25 MCQ question. So I'll read this September 25 case scenario which came for exam. 8 marks question. Quick Limited is in the business of production of life-saving medicines. It has sufficient cash funds available with it. It decided to buy back shares to the maximum permissible limit on 4th July. And on 1st July, company has the following capital structure. So the company is giving you the capital structure. Share capital 45 lakhs. General reserve, premium, P&L, revaluation reserve I will not use for buyback. Statutory reserve we will not use for buyback. Loan funds 350 lakhs. Oh, Quick Limited is considering to reduce the loan funds amount to 300 lakhs by paying loan funds amounting to 50 lakhs before 4th July. So remember they are reducing the loan amount before buyback. So 50 lakhs they paid. What is the entry when they pay off 50 lakhs? Loan account dated to bank. Loan adachu. So loan to bank. Loan to bank. Loan credit balance ആണ്. Pay off ചെയ്യുമ്പോൾ loan to bank. Now the current market value of company's share is 250, and to induce the existing shareholders to offer their shares for buyback, it decided to offer the price 20% over the market value. We have seen this type of adjustments. So 250 plus 20%, what is the buyback price? 300. So based on the information in the above case scenario, answer the following. What is the maximum permissible number of shares that can be bought back if loan fund is 350? If loan fund is 350, what are the calculations we have? If loan funds is 350, what we have studied? If loan funds is 350, okay, then what is the minimum equity required divided by 2, 175. What is the current equity? Current equity is, let's take the total of paid up share capital 45 plus general reserve 74, securities premium 30, P&L 25, 174. 174. But minimum we need 175. But we have is only 174. So is there any dilution possible? No, right now you cannot buy back. Sorry, you cannot buy back. We need 175, but 174 ullu. So can you buy back? No, buyback is not permitted. Buyback is not permitted. So what is the correct option? Let's see. What is the maximum permissible number of equity shares that can be bought back? Nil. Option C. Option C is the correct answer. Option C. 2 marks. Option C. Then, what is the maximum number of shares that can be bought back if loan fund is 300? Then 300. Minimum equity is 150. 174. Then 174 is the present equity. So dilution possible is 24 lakhs. So 24 lakhs divided by, this is 24 lakhs divided by, what is the buyback price? 300 rupees plus. So this is what I was telling. Instead of X and Y, just follow this. Buyback price plus transfer to CRR. So how much is the face value of equity shares? 100. Face value of equity shares is 100. So 24 lakhs divided by 400. Maximum number of shares that can be bought back is 6,000. Let's find out what is the option given. Option 6,000 D. Option D. Upper C, D. Option D. What will be the maximum number of shares that can be bought back as per Companies Act according to decision made on the basis of above two questions? Will be the maximum number of shares that can be bought back as per Companies Act. See, here I need to check 45 lakhs into 25 percentage. So here Companies Act, if the question is based on Companies Act, then what I need to say is 45 lakhs is the share capital. So 45 lakhs divided by 100. 45,000 is the number of shares. 45,000 into 25 percentage. 45,000 into 25 percentage is 11,250. 1. Then 2, resource test. 45 lakhs plus, what are the reserve balances? 74 lakhs plus 30 lakhs plus 25 lakhs. 174 lakhs. Resource test. Let's directly take 25 percentage of 174 lakhs divided by buyback price. So 174 lakhs into 25% divided by buyback price 14,500. And then debt equity ratio test 6,000. So as per Companies Act, least of the 3, what is the number of shares that can be bought back? Number of shares that can be bought back? 6,000 shares. 6,000, because if you have already paid loan, then 6,000 shares you can bought back. What will be the equity share capital after buyback? So 45 lakhs minus 6,000 shares means 6 lakhs. 39 lakhs. Is it correct? Is it that simple? Option C, option D, option D, Option D. Let's find out. 11, 12, 13, 14. 11, 12, 13, 14. C, D, D, D. So dear ones, maybe you will get a question on maximum number of shares that can be bought back, or you will get a question on journal entries to be passed, or you can get case scenario, but a definite question on buyback you can expect. So invest maybe one, I don't know. So here the video will be maximum 30 minutes. Adjust speed and watch. Be in touch. Don't forget these areas. That is the purpose of this videos. So try out maximum questions. Here this is just a revision video summarizing all the concepts and trying one question from the past papers. Okay, I hope this is useful. Thank you so much. We'll meet in the next video. All the best.